the theme that we have for today is what worked till now will not necessarily work in the future. So what people did till the seed stage may not work beyond. And what I thought we could do is we could break this down into 2 or 3 broad buckets of how we are going to look at it. The first one is in terms of business, where what worked in terms of your business model till now may not necessarily work in the future. And therefore, as founders, what is it that you need to do to preempt what is not going to work? The other bucket, which is quite important in addition to finance, is your people, processes and technology, and that as part of bucket 2 is what worked for you so far in terms of your people, processes and technology is not necessarily going to work in the future. So with that, basically I've made some notes in terms of how I want to go ahead. So the first question, and I'm probably just saying that in terms of, yes. Sagar, in terms of your experience with markets and sales, right? What would be your advice to founders in terms of what is your advice to founders in terms of when they look at their business strategies, what are the key areas where they struggle to scale up, and therefore how could they mitigate that?
Okay, good evening to all of you. I think generally marketing people complicate the matters. So I would like to simplify here. The simplest thing, I think, and we interact with so many startups actually, I think, on a daily basis. The general thing that's missing out actually is that most of the startups, in fact, I would say 90% of the startups are started by the people who actually have developed the product or the service. And marketing then comes as an add-on, or they try to do marketing themselves, and it's not very easy actually. So there are 2 things I would like to kind of put on the table. First and foremost, please do have a person who knows sales and marketing as either part of your team or as a part of co-founder team or whatever you may want actually. The second thing is actually, and which is the most basic thing when we are taught, like you're in the first class of MBA, you are taught is a STP. That's segmentation, targeting and positioning. And even the best of the best startup you ask them to define that who's your segment or target customers, I think they will fumble. They will give you an essay, but they cannot send in one statement who is their target customer. So a very simple advice to all the startup, and that's what honestly we look for when we talk about funding a startup. Do they have a clear idea about who is the target customer? I think people generally say इसको भी बेच सकते हैं, उसको भी बेच सकते हैं, ये भी हम है, वो भी कर रहे हैं, ये भी कर लेंगे, वो भी कर लेंगे. No, that's not where you succeed. It's always where you have a very sharp definition of your target customers, your segment, how you are going to target, and what's the positioning of your product or service.
Thanks, helpful. Amit, I have a follow-up question on that. Right now, you've had a team where you had a marketing person, salesperson, you're aggressively chasing growth. Now, with your experience in EdTech and FinTech, how do you balance excessive growth with sustainability?
I think it's a very interesting question, so thank you for that. Maybe I'll give you a little perspective about BLinC because that will put a context to everything. We've been investing in only these 2 sectors for last almost a decade or so, and from day one we've been always thinking about one thing, is that it's about we have to create businesses, not about create valuations and exits. Obviously we all need to make money, there's no question about that. So the mantra what we've been following for a very, very long time is revenue, cash flow and profit. So if you really look at most of my portfolio companies, and literally means most of my portfolio companies, actually are profitable within 18 to 24 months of investments, and we generally invest anywhere between, I would say, $1 million to about $4 million as well. And the reason we follow this is because if you really look at any of the large businesses which have got created in over 30-40 years, all these businesses have been created with billions of dollars over a very, very long-term period. And it's impossible to push the startup that you keep on growing at 100%, 200%, and not really looking at what you are creating. And that's the time when the challenges comes, in the sense you grow, you get your revenue, but you don't have your processes in place, you don't have your technology in place, or you don't have your compliance in place. And specifically in the education sector, what we have realized, and this is what we really talk to everyone, that it's all about outcome. This is a particular product. The beauty of this product is that if you really do the right things, your CAC can be zero, but you need a lot of patience, because the gratification from the consumer like us, we as a parents, or maybe we ourselves as a consumer, takes a while. And that is what needs to get created, and that actually needs a lot of patience. Or we really look at a product like, which is in the financial services, a loan-focused product. It's very easy to give loan, but very difficult to do risk and collection. And that's where you again need to really understand, which he obviously mentioned about your target segments and all this. Are they really going to pay? What is the needs of this money? Where the money will come? And that's where I would say all true quality businesses have been grown over a longer term period. And that's where we actually go ahead and tell our founders, and this is something which we have put it on record as well. We're okay if you don't grow by 100%. That's not our expectation. I would rather tell the founder, you grow by 60%, 70%, but get your unit economics in place, become more profitable, be sure what you are trying to achieve. And that is what really our focus is.
Thanks. I mean, two key takeaways from this answer. One was in terms of the kind of companies that you invest, the kind of unit economics you said. And for the other ones, I'll come to Vatsal and Geet in a bit. But what exactly do you look at when you make an investment in a company, when they're looking for that pre-seed to the next stage?
I think everyone knows that the founders make or break the company. So is it important to have the founder alignment? Absolutely yes. There's no question about that in my mind. That is very, very important out here. Right? So let's start with first the founders, and then we'll get into the business model. Now, when we look at the founders, we really look at it the softer skills as compared to the harder skills. And when I look at the softer skills means, is this a founder who is open? Is he the founder who is flexible? Is this a founder whom we can give a very blunt feedback, as if we give it to a friend, right? And to put it very, in a more funnier way, it's a Friday evening, is that the way a sort of a wife will behave to a husband, saying that, "Yaar, ye theek nahi ho raha hai. Don't do this." That's the bluntness. Literally, we want to have a relationship with the founders, and the reason is because if we don't get along, then it becomes very, very difficult to work with the founders. And I think in the previous presentation, one of the gentlemen did mention the journey of a finance team, how you develop a team. And that's truly a journey of all the startup companies. What is true for a 10 crore revenue is not necessarily true for a 100 crore revenue. The skill set required to build the processes, technology, or even your distribution channel is very, very different. Giving you an example, one of my portfolio company is going for an IPO. It's an education company, Imarticus Learning. When we invested, they were doing about 5 odd crores of revenue in the year about 2015 or so. As we speak, they're talking about 40 to 50 crores EBITDA achieved, and they've just raised 25 crores of capital, right? But the interesting part is, have they changed their CFO or the finance function guys multiple times? Yes. Have they had to change their sales and distribution guys couple of times? Yes, because what is going to happen is that when you manage a 12 people team is very different when you manage a 100 people team. Idea is not to tell them to quit, but it's also about building that capability. And sometimes the team is able to build the capabilities, and sometimes they are not able to, I would say, build the capabilities as well. So these are some of the things which we really look at when it comes to the founders. I think from a business perspective, our views are slightly different. What we really look at is that, I'd say many of the VCs say, hey, is this $1 billion opportunity? Is it a large opportunity that got created or not? And what we look at it that is this a particular business which can survive for next 10, 15, 20 years? Because in my opinion, some of the business gets created as well. Like when we, again, giving you an example, we invested from a current fund in a company called Raising Superstar. Now, I'm sure a lot of you would be parents. How many of you know that 0 to 6 years of age is the maximum development of the brain for the child? How many of you know about that? Right? Quite a few. But still there are a lot of people who is not aware. But 0 to 6 years is where 90% of brain development happens. Right? People are not aware of it. Now that's the product, how you define the TAM opportunity and everything. Right? It's a very different product. So it ranges from awareness to what it can really do to really make the parent aware that this is the most important time. And there's so many things as a not to do list. And what was the informal way of literally, I would say, knowing this is, prior it was our grandmothers, family members, then we have a WhatsApp group and YouTube and all this. Now, how much of this information is true and how much is not, right? There always is a contradictory sort of questions and answers to a lot of things we've been doing. So, this point of time, what we really look at, that is it a customer sort of must to have or good to have? Right? If it's must to have, it's so critical, then let's go and create it. And that's where we always have a lot of patience. And that's where we see that can we go and create the business model around this. And all this business model, sales and distribution he spoke about, all these are critical, but all this can get created if you know what your target segment is and you have patience. In my opinion, that is the virtue of growing a very, very long-term sustainable business.
But one last question. Is there any specific advice that you think entrepreneurs at this stage should think of when they scale up?
See, entrepreneurship is all about risks, right? There's no question about that. And I started similar when I started my fund. I also took that risk. So one has to be very clear that you are going to take risks. There's no question about that. So one is be mentally prepared that it's risk. Your journey will have one bump and maybe hundreds of bumps. If you look at my journey, I'm sure I had hundreds of bumps, good thing, bad thing, everything. So that's something you be mentally prepared. And I'm using this mental because in my view, entrepreneurship, 80 to 90% is your emotional balance, which completely make or break. It's not about the skills. Trust me, CAC, all the skills are very, very process oriented and we've implemented in 20 companies. And after that we say, oh shit, it's so easy. But the key question is your mental awareness to your mental sort of openness to understand why it is happening, what is happening. So we would say that that is extremely, extremely critical to really do it. The second is, as you are building team in the first 10 crores, 15 crores or 20 crores, I think it's extremely important to understand how you're building your team, and it's all about partnership, even with your team members. Right? And that is again a make or break, because if you choose the right guy, you'll move up, and if you don't, it just 6 months, 12 months goes away and always figuring out. So I would always say there's two things if we get it right. That is, one is the team that you are working with, and the second is your mental balance. I think most of the things will fall in place automatically, whether it's product, about customers, because enough books is there, enough common sense is there. But this too, to be honest, is a very difficult piece. It's not easy to find the right partner. It's not easy to find the right team, and right people at the right place is extremely, extremely important. Yeah.
Thanks, Amit, for all the insights.
Thank you.
Geet, he spoke a lot about team building.
Sorry.
No, it's for you. You spoke a lot about, you're very passionate about team building and technology.
I think taking away from Amit's point is exactly the contextual question. Yeah. Go ahead.
So my question was, when you look at scaling up your people, your team, what exactly do you keep in mind? How do you go about doing it?
So my first piece of advice would be that always hire for attitude. right? I mean, your functional competency can be lower, higher for attitude. And there are only two types of attitude: can do, can't do. And you're born with it, right? Most people are just born with it. You can't teach attitude. So I would always recommend that, and that's what I've done in my career. I've always hired for attitude, and it's been very successful. Competency can be taught, other things can be learned, but attitude is just inherent. So hire for that. An add-on point would be also hire for collaboration. No person can succeed alone. You have to be able to collaborate across the team. So some people are team players and some people are solo. So you have to decide how it works. So that's one point. But I think I would flip the question slightly, that it's not about just the people you hire, it's also about the behavior of the entrepreneur. I think building a good team is easy or easier. It's sustaining and nurturing a good team, that's a tough part. And that's why you see a lot of churn happening in startups. Common complaint being, I can't work with the founder, they're inconsistent. So they have this saying, right, when you point a finger, three fingers point back, right? It's an old Indian saying. So I think it's also important for entrepreneurs, founders to introspect and say, hey, what could I do differently? What could I do better? Not just to hire the right talent, but also to maintain that. And I think that's a very important time. Some tips over there, communicate, be consistent in your behavior, be patient. And I would say, as Amit said, hire the right people, but also give them space to operate, right? Many years ago, I coined a term called micro-monitoring, which is different from micro-managing, right? Hire people, establish that they are reliable, and then give them space to run. If you're constantly judging them, watching their back, they're not going to last very long with you. And that's true in any function and not just in startups, it could be anywhere.
Two or three things around people that you would advise startup founders to guard against. What is it they should not do?
Ethics and laziness. You can't compromise on either of these. That's easy.
Vatsal, coming to you. Now, when you evaluate companies, right, apart from the software items, what sort of KPIs, numbers, etc. do you evaluate?
One, we are fairly metric driven. What we look for depends on the kind of businesses that we are evaluating, but broadly that's kind of consistent across most of the businesses is, how are the unit economics? Are they profitable at a user or an account level? You're ensuring that you're not losing money on any customer that you have. How is the company growing quarter on quarter, year on year? How is how is the company growing within each customer, which we typically call as your expansion rate within a customer, and how are you overall from a profitability perspective? So are you maintaining a healthy balance between growth and profitability? That's broadly at a high level the metrics that we look at. Of course, then there are very industry specific, company specific metrics also to evaluate. Again, I won't go into too much detail there, but it's all to do understand with are you as a company growing faster than the market, and are you growing at with the healthy margins, right? You shouldn't be growing at the cost of margins. It's okay if you're doing it with a very clear visibility that I can turn around in the next 18 months, 24 months. But if that's not the case, then the growth at any cost is a challenge.
And typically in the initial stages, there's always a challenge around profitability. You're always burning. What's your take on that? How do you sort of keep that in mind when you make decisions?
So we are a very enterprise-focused investor. So I'm going to talk a little bit from that perspective. That if you're an enterprise business, you can technically never lose money on your at a customer level or at an account level. That's the fundamental of serving an enterprise. You're not serving an individual. If that's the case, you may be at a company level burning money because you are yet developing the product, you're perfecting it, you're building the markets, you are investing heavily in sales, marketing, branding. But as long as I said, as long as there is visibility into when I can turn this around, what is the tipping point where at a company level, at a corporate level, you can start generating cash flow, is what that visibility is important. It's not needed today because you are, of course, at an early stage where growing, capturing market share is important. You cannot be also just growing at 10, 15, 20% like a typical stable company would be. That's just not why you started up, right? If someone has moved out and started up, it's to get that hyper growth. So growth is important, but it's just that the visibility and the thought process needs to be there. It can't be that your business model is built on perpetual cash burn, because that doesn't sustain. But of course, at an early stage, we understand as investors, we understand, and that's where our capital is required for. If you were profitable from day one, then you wouldn't need capital. So the entire need for capital is to build some of these intangible assets that we call. If you're building tangible assets, you have banks who are ready to finance you. It's because you're building some of these intangible assets which a typical financer is not going to be willing to underwrite, is when you need venture investor or a private equity investor who's willing to underwrite on that intangible asset that you're building, which could be your brand, the market, investing in your sales and marketing efforts, investing in building a software product. That's the cost that we help you invest for, but that should yield recurring results with a visible time frame.
Sure. Sagar has spoken a lot about people focused or investors focused about sales growth. Now, for you, you've looked at sales and processes both, right? Now, how do you balance sales versus processes in an organization?
So I think generally sales is a very dirty word for most of the people. But honestly, it's my sincere advice to all the startups. The most critical part in your organization is sales. And never, ever, ever, ever think that it is like a dirty job. I think as co-founders or founders, if you are not willing to meet customers, then God bless the company actually. Now, I think there is always a dichotomy, and in fact, I can share two experiences of organizations I have worked in my career, and I can give example of Airtel versus Pepsi, and I have worked in both organizations, and one is a completely sales-oriented organization, which is Pepsi. I mean, look, you hell with the process, it doesn't matter. You just go and achieve, and there are individual heroes you create, and individual is worshipped. And there is a organization, Airtel, which actually was a completely sales-oriented organization in the early, I would say, 2003, 4, 5, 6. And from 2008 onwards, they actually completely shifted to process. And you will not believe, in the telecom company, there was a business excellence guy at the executive level in each circle, whose only job was to ensure that processes are copied from one circle to other, developed, followed, etc. Now, and that's where, if you see the telecom storm, from 3-4 companies to 12 companies down to again 3 companies, which is the company that has survived? It's Airtel. And it's so amazing what processes can make the difference. Now, for startups, you may think, okay, Airtel to badi company hai yaar, unko ye sab chonchle अच्छे लगते हैं, हम क्या करें actually? Very simple thing. For startups, because you don't have so much of, you can say, resources available, it's important that you spend less and less time in inducting and recruiting as well as training the new employees. Now, this can only happen if you are process driven. Otherwise, you spend all your time, because there is going to be churn, like you are very, very happy if the churn is less than 50%, but it's generally more than that. So you are always going to kind of start from zero, get a person to a training level, wo nikal jayega, again second person comes. So you spend your time eternally on this training part. But if you have processes, then that's where it makes a difference. And I had the fortune of working in a very small company which had a turnover of 7 crores when I joined, and then I worked with that company in 2 stints, 7 to 50 crores, and then actually from 100 to 180 crores. It was a very small company, but everything was process oriented. I mean, that company had SAP implemented at a 100 crore turnover, where people don't think unless you do 5,000 crore turnover, people don't talk about SAP. But that was the kind of focus on process, and it works actually. So I think if you are thinking long term, focus on process. But whether you are thinking short term or long term, never give up on sales.
And you made an interesting point about an entity moving, pivoting. It could be either from business to or less processes to processes, or it could be pivot in terms of which business to another business. Is a question to each of you. Whenever that pivot happens, right? How do you manage your investor? I mean, clearly there will be a time when the investors may not expect this kind of a change. They would need to be comfortable with any big shift, right? So when you are managing an investor, communicating with an investor, how do you go about with this kind of a shift?
I think that's a very tough question to answer, and I don't think there's any playbook on that. I mean, will pivots happen? Definitely. I mean, that's part of the game of investing in startups or being an entrepreneur running a startup. But I think, in all things in life, communication is key. Communication in terms of conversation, communication in terms of MIS, what's happening. Because from an investor standpoint, I think, is that pivot necessary because there's some change in the market condition? Is it that, the original PMF was wrong? Is it that the founder is pivoting too often and doesn't have the patience to see through the, pivot? I think it's a very tough question, and I would myself struggle to answer that. I think it's probably unique. Every case is unique and has to be evaluated as such. Right? But in general, communication is very important.
Okay, while I think Geet talked about how to address the investors, I would talk about the importance of pivoting actually. So, generally it's a negative word actually that business pivot kar diya. I'll give you 2 classic examples. Without naming the person who has founded 2 unicorns in India, and we have a very close association with that person, and we meet him quite often. One of the questions when I asked him, he said that, Sagar, I have pivoted the unicorn that was formed, the original business model 3 times, and then it became a unicorn. So I think his point was very clear that if the founder has sharp acumen, bank on it, let him or her pivot the business multiple times, it doesn't matter, because he or she is passionate to make it successful, and that's what investors look for. So that's number 1. The second point actually about pivoting a business is that sometimes we feel that why should one pivot a business actually? But there is a very classic saying, and that's the one thing that has always remained in my mind, that as a owner of a product, if you don't kill your product, competitors will. So it's important that if you don't like the product, if you find that it's not working, if you find the service is not working, please kill it yourself. And I think everybody has seen this classic example. The best selling car, I mean in that SUV segment, was a Collis, if I'm sure people would know actually. And at the peak of sales, they decided to stop that sales. And then they struggled for 1 year to come up with a new model and get that. But that's the vision. that you can kill the product yourself, it's better than competitors killing it.
What we tell our founders is don't look at us as policemen, right? We're not there to kind of keep monitoring you. We're your fellow travelers in your journey. That's the way we would like to work with our founders. It's absolutely okay to pivot as long as we share the same vision. There will be, of course, difference of opinion and all of it at a board level, which happens in every business decision. It's nothing to do with even just a pivot. But said that, communication, if you take your investors in confidence, it will actually help you rather than, trying to do something and then at the last minute, founders, because they're not sure of how investors will react, they typically, will spend time trying out something, whether it's working, not working, it reaches a certain level and then it, bring it up to the investors saying, hey, we've already done this, it's working, or we spent so much amount on, building this, it didn't work, now what do we do? Instead of that, if, from the beginning you have your investors on board saying, hey, this is what we're doing right now is not working, we need to pivot, this is what we believe will work, all of us are ultimately working towards the same goal. We're essentially and factually sharing equity in the same company. All of us are working towards the same goal of creating shareholder value. So if you believe this is something that will work, you're the founder, we're not the founders. You are the one to drive the company and know your customers the best. Your investors will typically support you, and that's what it is. That's how it has to be. So bottom line is, be as candid as you can. We would love to get the problems from you and help you solve it, rather than you trying to hide the problems and then, it ballooning into something much bigger at a later point in time. Of course, I know of some investors who are on the opposite spectrum and, they will come back to founders with a very harsh attitude. But that's few of the investors.
Just one point, sorry, Geet, but I think the best thing to explain the investors when you are trying to pivot is that, are you willing to put good money after bad money? I will stick to that model. I will not pivot my business. But if you are not, then it's better for me to pivot the business.
Great points. I'll add one more context. Again, looking at it from the investor, not from the investor standpoint, but let's say, one of the things that become popular now is from investors to be active investors, right? It's not just about putting money into a startup and then, letting the founder do what they want. But I think this term has got slightly abused by the investors. Maybe we feel that, I think that was a great point that Vatsal made, that we are not the operator, right? We can be a sounding board, we can be, something to bounce ideas off, but keep the communication channels open, right? But for investors also, sometimes it's important to take a step back and say, how active is overactive, right? And kind of step back from some of those things, right? Because it's fashionable now. We are active investors. We are helping the startup. Maybe sometimes the startup just needs a sounding board advice rather than, the police giri that you mentioned. Perfect.
Of a friend and a fellow traveler than a master and disciple relationship.
Somebody said wife. Right?
And maybe one last question again. Any blind spots you would advise startup founders to guard against in their journey?
I don't know, just choose your investors and co-founders wisely.
Okay, I think one point is mentioned, so I won't repeat that. But it's critical that when you find that it's not going your way, have a courage to step back and go in some other direction. Don't keep going there.
I have a very long list. Just joking. But I think we've covered that. I think governance is a key point. That's very, very important. It's been kind of highlighted now in the last couple of years, but I've had my own experiences as an angel investor in startups where revenue recognition was poorly done and led to all kinds of complications. So that's one thing. And I think with that, it's important to walk the talk, right? I mean, the founder has to set the example on these kind of things, on governance, and that could be any processes. I think it's no longer a blind spot, but I would encourage constant attention to that. I think we already covered that in the earlier sessions, so I'm repeating my.
Thanks. Thank you once again to all the panelists here for this extremely insightful pointers that they've made.